Welcome to the Insurance Industry Sector Risk Assessment presentation. This presentation will provide you with an overview of the insurance sector, the domestic and international insurance sector specific assessments, its combined sectoral risk assessment, a summary of the inherent risk faced by the insurance sector, and finally, key takeaways that will aid you in the adoption of your risk-based approach for anti-money laundering, combating the financing of terrorism, and proliferation financing. The insurance sector of the Cayman Islands has two distinct sectors, the domestic sector and the international sector. The domestic sector, as at December 31st, 2019, was made up of 26 insurance companies, 23 insurance brokers, and 44 insurance agents, offering general and long-term insurance to residents and businesses of the Cayman Islands. Approximately 96% of the premium received by these entities are from property, health, motor, and other general insurance products. The international insurance sector, as of December 31st, 2019, included 646 insurance companies and 24 insurance managers, offering insurance to residents and businesses outside of the Cayman Islands. Approximately 96% of the premium received in the international sector was derived from property and casualty insurance and reinsurance contracts. In 2019, the authority conducted risk assessments for the following sectors: banks, Category A and Category B, money service businesses, trust and corporate service providers, insurance, mutual fund administrators, securities licensees, and civil EPs. A summary of the sectoral risk ratings for all sectors was published on the CIMA website on the 13th of March, 2020. The domestic sector accounted for approximately $800 million in total direct premium income in 2019. General insurance is the predominant contributor due to mandatory health and motor insurance, and the popularity of property insurance due to hurricane and wind exposures. Direct life insurance premium accounted for 4% of the total premium. Life insurance products sold included mortgage protection, credit life, and policies with investment features. The Cayman Islands is the leading domicile for healthcare captives and group captives, with a rapidly growing reinsurance sector with approximately 90% of the risk originating from the United States of America. Total direct or reinsurance premium income of approximately US $18 billion was accounted for in the international sector in 2019. Approximately 86% of the premium was from property and casualty business, and 10% from life reinsurance. Direct life accounted for 4% of the total premium. In 2015, the Cayman Islands undertook a national risk assessment to which a medium level of vulnerability was attached to the insurance sector. A sector-specific risk assessment was conducted in 2019, and the insurance sector was rated on a scale of low, medium high, and high against the 5 inherent risk areas recommended in the FATF for the recommendations, namely nature, size, and complexity of business, products and services, delivery channels for products and services, customer types, and geographic risk. A subsequent national terrorist financing risk assessment was conducted in 2020, of which the insurance sector was rated as a medium. The sectoral risk assessment determined that the nature, size, and complexity of business inherent risk was low. This was as a result of the following factors. All insurers and intermediaries are licensed and supervised by the authority. Approximately 96% of all insurers carry on general insurance or reinsurance business using non-complex structures. Approximately 77% of the international insurers are captives and are managed by insurance managers and brokers with a physical presence. Shareholders, including UBOs, are vetted against rigid due diligence standards for fitness and propriety. Insurers' operations are limited to the approved business plan, with changes requiring prior approval. Additionally, Overseas regulatory checks are conducted on shareholders and affiliates on a periodic basis. Products and services was rated as medium-low risk, as 96% of the insurance business is general insurance or reinsurance, which is considered low for money laundering, terrorist financing, and proliferation financing exposures. While life insurance products with high cash surrender values, premium payments made in cash, and the potential for the misuse of pure captives by manipulating funding and reserves increase the inherent risk, these are mitigated through the following: the involvement of independent actuaries, auditors, and other professionals and regulated service providers in the insurance and wider financial services sector. Adequate due diligence is conducted by insurers prior to issuing insurance policies and vetted by designated knowledgeable individuals performing the Money Laundering Reporting Officer, Deputy Money Laundering Reporting Officer, and the Anti-Money Laundering Compliance Officer functions. The fines and penalties regime on anti-money laundering, combating the financing of terrorism, and proliferation financing breaches heightens the awareness to the money laundering, terrorist financing, proliferation, risk exposures. Delivery channels for products and services was rated as medium-high risk, as the insurance sector can rely on eligible introducers, utilize online platforms, and issue policies involving unrelated front-end carriers. The inherently riskier activities are mitigated through the fact that the domestic sector is largely a face-to-face business by licensed insurers and insurance intermediaries alike. Licensed insurance managers manage and deliver services in the international sector. Captives and reinsurance companies provide coverage to sophisticated entities. Continuous product and AML, CFT, and PF training is undertaken by insurers and intermediaries. The performance of intermediaries are closely monitored, and finally, directors are held responsible and accountable for all insurers' activities. Customer types was rated as medium-low, considering insurance products cover high-risk industries, PEPs, high-net-worth individuals, and is largely cash-intensive. Over 90% of the international insurers offer coverage to shareholders, affiliates, and regulated entities. Geographic risk was rated as low risk, as the domestic insurers offer products and services to residents and businesses in the Cayman Islands. Approximately 90% of the risk covered by the international insurers and reinsurers originate from the United States of America. The risk assessment determined that no insurance transactions have been undertaken with sanctioned countries and individuals. Entities should consider the insurance sector risk assessment results in conducting their institutional anti-money laundering, combating the financing of terrorism, and proliferation financing risk assessments, and in taking measures to apply a risk-based approach, including consider the level of business with regulated and non-regulated service providers. Know the location of policyholders. Scrutinize insurance products that offer high surrender values. And consider customers living in countries subject to sanctions. When adopting your institutional risk-based approach, identify AML, CFT, PF risk based on customers, including beneficial owners, products and services, delivery channels, and geographic location. Identify and apply measures to mitigate and manage AML, CFT, and PF risk. Implement policies, procedures, and IT systems to monitor changes in AML, CFT, and PF risk exposures. Document the risk assessment, strategies, and policies and procedures to monitor, manage, and mitigate, and report these measures to the governing body for approval and oversight. Here is a list of references and resources that may provide additional guidance. Thank you for viewing this presentation. For additional queries, please email us or visit